Welcome to Sophie Daddy's channel. Okay, let's dive into this. You hear all about options, right? This promise of explosive profits. But for most traders, they deliver something else entirely, just spectacular losses. So in this explainer, we're going to break down the real reasons why so many people lose money in the options market. And trust me, it's often not for the reasons you think.
And this quote just frames our whole topic perfectly. See, the author here, Simon Gleadle, he's not talking about the obvious stuff, like buying a call and watching the stock tank. No. He's pointing to all the hidden traps, the technical blunders, and these moments of sheer ignorance that can just obliterate an account before you even know what hit you.
So that brings us to the big question, right? If it's not just about being wrong on the direction, what are these cunning pitfalls he's talking about? Well, as we're about to see, the real reasons for failure are way more predictable, they're more systematic, and thankfully, they are way more avoidable. And it all starts long before you even click that buy button.
So, our first area of risk, it's the one you actually have the most control over. It's the person staring right back at you from the screen. Yep, the most devastating mistakes often come from right inside our own heads.
Okay, the number one absolute foundational error is just jumping into the market with no defined plan. And this isn't just like a friendly suggestion, it's a critical flaw. Without a plan, you're not really trading, you're gambling. And every single decision becomes impulsive and emotional, especially when your real money's on the line.
And this is what a real plan looks like. A solid plan takes the decision-making out of your hands in the heat of the moment. It moves all that critical thinking from that high-pressure, live trade situation to a calm, analytical state where you can actually think clearly. Every single one of these points has to be defined before you ever get into the trade, period.
But look, even with the most perfect plan in the world, you're still human, right? Emotions like fear and greed can totally hijack your brain, causing you to systematically break your own rules. And this leads to that classic recipe for disaster. You cut your winners short, and you let your losers run.
And here's the why behind all that destructive behavior. This little cognitive bias, loss aversion. It's basically hardwired into us. The pain of actually admitting you're wrong and taking a loss is so intense that we'll do completely irrational things to avoid it, like holding on to a losing trade and just hoping it comes back. And that often turns a small, manageable problem into a catastrophic one.
So when you combine that psychology with poor risk management, like betting way too big on a single trade, you put yourself in a mathematical hole that's just incredibly difficult to climb out of. A 50% loss doesn't just set you back. It means you need 100% gain. You have to double your remaining money just to get back to where you started.
Okay, so beyond what's going on in our own heads, there are these risks that are just baked into the options themselves. These are the unseen forces. You've probably heard of them, the Greeks, that can make you lose money even when you were absolutely right about where a stock was going.
I want you to think of a long option, like a melting ice cube. Every single day, a piece of its value, its time value, just disappears forever. That's theta. And this decay, it isn't a straight line. It accelerates like crazy as you get closer to expiration, which makes those short-dated options a really dangerous game for anyone who's unprepared.
This completely reframes the whole bet you're making as an option buyer. The question isn't just, hey, will the stock move my way, but it's, will it move enough and fast enough to beat that guaranteed daily cost of time decay? I mean, if the stock just sits still, you lose money every single day.
And here's another silent killer, implied volatility, or IV. Just think of IV as the market's price tag for uncertainty. So before a big event like an earnings report, uncertainty is super high and options get really expensive. But afterwards, once the news is out, poof, that uncertainty premium just evaporates, crushing the option's price.
Okay, this table shows the IV crush in just brutal detail. So look at the start. The trader bought a call for $7, and they were right about the direction. The stock went up 5 points from 100 to 105. But notice that extrinsic value. Before the news, it was $7. After the news, all that uncertainty vanished, and it collapsed down to just $1. That $6 loss from the IV crush completely wiped out the $5 gain from the stock's move, and they ended up with a 14% loss on a winning bet. It's insane.
And if you're an option seller, your nightmare is gamma. So if you've sold an option, you are what they call short gamma. And what that means is the more a trade moves against you, the faster your losses pile up for every dollar it moves. Your risk isn't just getting bigger, it's accelerating, creating this dangerous feedback loop that can just spiral completely out of control.
And finally,
The very structure of the market, the products you're trading, they contain their own hidden traps. These are those little mechanical details that can absolutely make or break your whole strategy.
So a lot of traders just assume that tracking the same index with different products is basically the same thing. Well, it's not. Choosing the wrong product for your strategy, like using options on the SPY ETF versus the SPX index, can lead to totally unexpected risks, being forced into a stock position you didn't want, and a much, much higher tax bill.
This comparison is so crucial. Let's focus on two key differences here. First, exercise style. SPX options are European. That means they can only be exercised right at expiration, so no early assignment risk. But SPY options are American, which means you can be assigned and forced into a stock position at any time, which is a huge risk, especially around a dividend payment. And then there's settlement. SPX settles in cash, while SPY settles with actual shares of the ETF.
And here's the difference that hits your wallet the hardest: taxes. SPX gains get this special tax rule, Section 1256, which gives them a much lower blended tax rate. SPY gains, on the other hand, they're typically taxed at your higher ordinary income rate. I mean, this is a massive difference that directly impacts how much money you actually keep.
And believe me, the list goes on. The source materials we looked at detail dozens of these little landmines. You've got stuff like Texan delta hedging. That's where you accidentally hedge in the wrong direction and literally double your risk. There's pin risk, which is getting trapped by a stock that's hovering right at your strike price on expiration day. Every one of these is a story of a blown-up account just waiting to happen.
So after hearing all that, how in the world do you navigate this minefield? How do you survive? Well, the solution isn't some secret formula. It's really about having a disciplined, professional framework to work from.
So this action plan gives you a really clear path forward. It's not about finding a magic bullet. It's about constant, disciplined work. You have to study the mechanics. You have to stay focused to avoid those careless clicks. You've got to know the rules for your specific products, constantly assess your own process for weaknesses, and most importantly, you have to learn from every single mistake you make.
At the end of the day, success in options isn't really about predicting the future. It's about managing uncertainty and controlling the few things you actually can: your plan, your psychology, your position size, and your knowledge. So by focusing on avoiding these common pitfalls, you can really start to shift the odds in your favor. Thanks for watching.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.